Hi friends, I am discussing here transfer of share by non-resident to resident. So NRI is transferring share to resident. They have to get the computed capital gain as per the Income Tax Act, and FEMA pricing is there. So what is the process for transfer of share? In nutshell, I give an example to you. Suppose NRI is selling their share to another resident. I am a buyer and NRI is selling share. We need to valuation from the FEMA perspective. Pricing guidelines is there, and as per the income tax, we also see what is the fair market value of the those shares. So NRI is selling their share at 1,000. That is agreed upon between the buyer and seller, but the Income Tax Act says the fair market value of that particular share as per the rule 11 UA is 5,000. So I am buying share at 1,000, but the fair market is 5,000. So from the perspective of seller, the NRI has to pay capital gain tax on the full sale consideration as per section 50 CA. Right. Here I am discussing section 50 CA. So section 50 CA says where a consideration received or accruing as a result of transfer by the SSC of a capital asset being a share of a company other than the quoted share, we are dealing in the unlisted shares, is less than the fair market value of such share determined so prescribed as per rule 11 UA. The value so shall be determined for the purpose of 14 shall be deemed to be full consideration received. So as a non-resident, you are selling only 1,000 per share, but the value is 5,000. So we will assume capital gain share consideration is 5,000. So what I am saying, so once you are dealing with the non-resident, do get it valuation as per the 11 UA from the Income Tax Act. Also get it valuation from the FEMA perspective also. The valuation, we should not deal lower than the transaction cost. It is prohibited as per the FEMA RBIs also. So from the perspective of buyer, I am discussing here section 56(2), subsection 56(2), subsection 2, clause 10 is there. Clause 10 is there, says where a person receive, I am a resident, from a person on or after this 10 is came into force from the 1st April 2017, any money or without consideration, aggregate of value which is exceed 50,000, the whole aggregate value shall be taxed as a notional income in the hand of income from other sources by the receiver buyer, since you are buying share at 1,000 but the fair market value is 5,000. So this 4,000, it's your notional benefit, we will charge to tax in the buyer hand in as per section 56(2)(10). So for the purpose of transfer by share non-resident to resident, we also see there is a RBI compliances there. FCTRS form we need to file. While filing a FCTRS form, while filing form FCTRS, there is a general provision. So share may be transferred as a sale gift between non-resident to resident. Non-resident can be FII or overseas corporate bodies. In certain cases, transfer of share require prior approval of RBI under the FEMA. Transfer between the parties where one of the parties non-resident and foreign company, such transfer as per the FEMA. So rule procedure for transfer of share. The RBI grant a general permission for international transfer of share. right? This is a general permission. So, transfer of share in a private company, Indian company, by a non-resident to resident require prior approval of RBI, right? We are making a foreign remittance to outside India. We need to file FCTRS form. The company is required to get a FEMA valuation, also fair market valuation as per the income tax 11U rule applicable in such case. This is the unlisted company criteria. If we are a listed, then SEBI LODR guidance is also need to be followed. So, for the purpose of foreign remittance, we need these forms, consent letter signed by the transferor, this is the NRI, and transferee, which is may also duly appointed agent, power of attorney authorizing the agent purchase share, there must be a purchase agreement of shares, shareholding pattern, what is the pre-shareholding, what is the post-shareholding. In case of transfer, NRI or OCB, all the copy of RBI approval which prove the share is held by them. There is a repatriation or non-repatriation basis. Repatriation is foreign remittance. A certificate from the chartered accountant must be provided and must be affixed in FCTRS form. Undertaking from the transferee that all the pricing guidelines has been strictly followed. This pricing guidelines is a FEMA perspective and no objection from an income tax authority or chartered accountant. So, this is the form 15CB. So, this is the story for transfer of share by non-resident to resident. We need to check fair market value for the income tax perspective as well as the pricing guidelines of the FEMA. We must get a chartered accountant certificate for valuation purpose. Registered valuation valuer certificate is not come in play in this scenario. While making a valuation, we follow net asset method on the transfer date for the purpose of rule 11U. What is our asset? A plus B minus C is the simple formula is given in the 11U. So, this TRS form is need to be filed with the RBI FC TRS form. There is a separate portal with the RBI. So, this is the whole story for transfer of share. Capital gain is come into play since you are making foreign remittance by the buyer to seller. There is no engagement of company. Buyer buying the share from the another shareholder who is a non-resident. So, buyer need to make a foreign remittance. There is a section 195 is again come into play for international area. Since this income of capital gain is accrualized in India, as per section 911 is taxed in India. So, non-resident shareholder getting a capital gain income is liable to tax in India. So, while making a foreign remittance, we must deduct a withholding tax. So, DTA, double taxation avoidance, indexation benefit is not there. Now, I will discuss here. Now, we will discuss the income tax implication on the transfer of equity share from NRI to non-resident. As I said, section 911D of the income tax, any income accrue arising whether directly or indirectly through or transfer of capital asset situated is deemed to be accrue arise in India. Hence, the capital gain from sale of shares are taxable in the hand of NRI. Tax need to be deducted, right? Also, certificate from the AO is required. AO certificate is not required. This certificate is for lower rate of TDS tax. If you are getting a certificate from CA in 15CB, there is no need for go AO. NRI also not eligible for indexation benefit and deduction. However, they can avail the benefit from DTA since you bought the shares at 10 rupee, but the 10 year after you are getting this, there is a no benefit for indexation. Under the DTA, there is two method for exemption method or tax credit method. The exemption method, special provision, exempt NRI from the filing tax return since you have already withhold the tax if their source of income is only include investment income as a long term capital gain, and for which you have already withhold tax. There is no required to file ITR in India, since you are gaining capital gain from India. So conclusion remark is here, the scope of work is so wide for transfer NRI to resident, and compliances is so difficult. It is not easy to comply with all the law correctly. There is the RBI FEMA implication is there, simultaneously income tax provision is there. So within time limit we have to see whether all the compliances, all the necessary certificate and valuation perspective we have checked. After that we can file form FCTRS. So this is from my side for transfer of share from NRI to resident. So thank you guys.